So, I'm going to talk about Keynesian economics in what we call finance-led capitalism. I sent a paper, so I hope you can get hold of it, which is called Consumer Debt as a Center of Finance-Led Capitalism, so which developed some of the aspects I'm going to present today. And this paper has been written by Robert Gutmann, who is a professor at Hofstra University in the US, and myself. So the outline of this presentation, my presentation, would be to say a few words about finance-led capitalism in the context of neoliberal policies, and then I will try to describe, to analyze what I call puzzles, a few puzzles which concern, in fact, the three major sectors of our economy in a standard Keynesian framework, that is the households, business sector, government sector. And I will end up talking about stability and the subprime crisis, and I will end up with the same conclusions as Paul yesterday, saying that in fact the subprime crisis we are experiencing now clearly shows that we have a comeback of Keynesian economics. So let's say a few words about finance-led capitalism. This is a regulationist concept. I'm sure a lot of you here in this university know what is the School of Regulation, which is a school at the confluence of different theories: Keynesian theory, institutionalist theory, Marxian economics. And the idea is that at different stages of the evolution, historical evolution of capitalism, we have what we call different growth regime. And today, we are since the early 80s, we are in what we call finance-led capitalism. What are the drivers of this change that we experienced and that led to this finance-led capitalism? Well, the previous growth regime was called the Fordist regime in the post-war period, and it collapsed because of the decline in profit and profit share, so the decline in profitability of investment, and also because of stagflation, that is, reduction in growth and inflation. But one of the reasons why we have this change in growth regime was also the neoliberal policies, which were initiated by Thatcher and Reagan, by the end of the 70s, with deregulation policies, privatization, and also what is often called the monetarist revolution. One of the main features, main characteristic of the finance-led capitalism is the process of financialization. And what I will show now is one of the major consequences of the financialization process is that we have a decoupling of expenditures and revenues in the four sectors, that is government sectors, household sector, business sector, and external sector. And this is what explains the different crises that we have seen since, let's say, the last 20 years. This leads to financial instability. Let's start with the consumption puzzle, which we could call also a Keynesian puzzle, where we have a decoupling of or separation, if you want, between household spending and the evolution of their income. What do we see in the data? Well, we see that in the major advanced economies in the world today, in the recent time, we had a decline in income shares of labor. This can be seen, for instance, in this diagram. I don't know if you see it very well. It's an IMF diagram showing the decline of the share of income since the 80s up to the current period, okay? The sharp decline. This is one of the line is G7 countries, and the one is OECD's countries, okay? So no doubt there have been a sharp decline in the share of income. And where is the puzzle? Well, the puzzle is that at the same time, we see that in major countries, we have an increase in household expenditure shares. In other words, within the GDP, the share of household expenditures have been increasing, and consumption rates, or if you prefer consumption propensity, also have been increasing. This is true in the US, this is true in Japan. It's not the case in Europe, where we have a stability, but we don't have a decline in these shares. So, what are the explanations for this puzzle? Well, clearly, the role of financialization has been very important. We had different effects. One series of effects is wealth effects, or if you want, the price of assets effects. In other words, in the US, clearly, during the recent boom, you had a very important role in the price of real estate on the expenditure of households. And this has been coupled with innovations like home equity loans, which allow households in the US to borrow in function of the evolution of the price. So when you have a bubble, when you have a bubble on the real estate sector, you have an increase in loans, which increase consumption. So the idea is that we are in an economy today where what we call in our paper with Robert Gutmann, a consumer debt economy, which plays a very important role in the dynamic of the evolution of capitalism. So here I have figures. I'm sorry you won't see it, but I will give comments on them. Here it's private consumption expenditures as a percentage of disposable income. So in the EU, this is an unweighted average, you can see that you have a fairly stable evolution since the 70s up to the year 2000. It's about 2.66. And at the end of the period, 0.65. So we can see it's a relative stability. But if you look at the US, you can see that it goes from 0.7 to 0.8. And in Japan, from 0.61 to 0.71. So clearly, you have an increase in consumption rates in Japan and in the US, and a fairly stable profile in the EU. And, of course, this is a consequence of this evolution. You can see that the debt ratio of household has been increasing sharply. In the US, for instance, it goes from 93% of household income to 135%. In Japan, 113 to 132. Okay, and we have also an increase in household debt in Europe. So the idea is that this decoupling of household income and household expenditures is explained clearly by the debt, which has been increasing enormously in these countries, and by the fact that innovations also, and also fiscal policies by government, which have been encouraging, the debt of household, has played a very important role. So this is so far for the first puzzle. Let's go now to the second puzzle, what I call the Marxian Puzzle. According to standard Marxian economics, capitalists strive to increase their accumulation of capital, and they do so by increasing the share of profit, okay, in the income distribution. What do we see? We see that, in fact, we have an increasing share of profit in advanced economy, which is, of course, the mirror of what we see with respect to wage income share. So the decline of wage income share corresponds to an increase, of course, of profit shares. But statistical data show that there is a slowdown in productive accumulation in major advanced countries, and a decline in investment as a percentage of operating surplus. So here is a puzzle. This is a contradiction between with respect to what Marxian economics is saying. This is why I call that the Marxian puzzle. What kind of explanation can we give? Well, the Keynesian view clearly has an answer for that. it says that profits do not play a direct role in investment in the business sector. What is important is expected demand, effective demand, if you prefer, to explain investment. So there is no contradiction with respect to Keynesian economics. Another explanation, more recent explanation, has been put forward by Lazonick and Sullivan in a paper in 2000. What they say that in a finance-led capitalism, there has been a change from retain and invest. In other words, in the Fordist regime, business firm would retain profit and invest them, whereas in finance-led capitalism, they are trying to downsize their productive capacity and distribute their profit as much as they can to shareholders. So this could be an explanation of the gap we see between investment and profits. Another explanation is that today in modern corporation, we have new forms of external growth like foreign direct investment, externalization process, which in fact take care of the growth of the productive capacity of firms. So the data we have, that is growth investment, productive investment, is not a good approximation of, in fact, the growth of the productive capacity of firm. Okay. So there is a problem, a statistical problem, let's say. Here is the figures which illustrate for the EU countries the relative evolution of the profit share as a percentage of GDP, okay, and the evolution of investment share. So you see very much what we call the scissor effect, with these two blades going in opposite direction. You have an increase in the profit share, but a decline, relative decline in investment share, which was not the case during the previous Fordist regime, accumulation regime. We have also figures here showing the evolution of investment as a percentage of operating surplus. Well, you can see that as well in Europe, US and Japan, you have a decline in this ratio. For instance, if you take the EU, it goes from 47% in the 70s to 40% in the year 2000, okay? And we have exactly the same type of evolution in Japan and in the US. Let's go now to the third puzzle, the neoliberal puzzle. As this expression is by Stockhammer, who wrote a paper on this type of changes, in finance-led capitalism last year. What do we see? Well, the puzzle is the following. We see that according to neoliberal policies, anti-Keynesian policy, we should have a downsizing of the state, and in particular of public expenditure relative to GDP, okay? But what do we see? In most advanced countries, the share of public expenditures, including social expenditures, did not decline, and this is what we may call a neoliberal puzzle. In other words, neoliberal policy did not succeed in reducing the share of public expenditure. Here is a diagram taken from OECD data for OECD country, and you can see this is the share of public expenditure, government expenditure relative to GDP. You can see that from the 70s up to now, there is no specific trend, declining trend, okay? So among the explanations that are given, some people say this is not true because in fact, when you look at the composition of public expenditure, you can see that there have been drastic changes. This has been the case in the sense that public debt has been increasing and that interest payments within public expenditure have been increasing. And since most of the interest payments go to high income brackets, and people will have a lower propensity to consume, so this means that this public expenditure do not have a strong impact on growth as it used to have in the previous regime. In fact, we have to be very careful, of course, using macroeconomic data like that, because it seems that indeed neoliberal policies succeeded in some ways to reduce the influence of the state in most of the advanced economy, and also I think in emerging economies in some cases, through privatization policy or deregulation policy. And this, of course, you cannot see these types of policies through public expenditure. So now I go to the next, fourth puzzle, which I call, and I think Stockhammer also called it the same way, the Minskyan Puzzle. Well, according to Keynesian economics, finance has a pro-cyclical role in economy, in the sense that it has an impact which tries to boost business cycles. In other words, when you have going up, finance is boosting activity and investment, and when on the downturn, on the contrary, it has an impact of reducing the activity. So we have the Minsky model, of course, which are very well known for that. You can also talk about the Bernanke and Ali model, the accelerator model, which also is trying to represent this type of acceleration process due to finance. But what do we see? If we look at the business cycles, since the acceleration of financialization, in particular since the 90s, well, you can see that business cycles has been smaller, okay, during the recent period. In other words, in spite of the fact that we had financialization, which is supposed to increase the business cycle through, for instance, accelerator process, we don't see that in the data, okay? And when we look at the recessions we had in the US in particular, the recession were fairly mild, in particular in the early 90s and in the early 2000s. So this is a kind of puzzle. In other words, financialization did not lead to increased business cycles. Here is a diagram with respect to the US, the rate of growth of the US economy, okay, since the 70s up to now. And you can see fairly well that during the recent period, in other words, since the 90s in particular, you have a milder, okay, evolution of the rate of growth of GDP, okay? So this is one point. In other words, we have a more stable rate of growth in spite of financialization. This is what we call the Minskyan Puzzle. So what are the explanations for that? Well, one explanation could be what I mentioned already, the existence of automatic stabilizers, since public expenditure did not decline much. The high level of consumption, which I mentioned already, which boosted growth. Active monetary policy, sometimes I would say aggressive monetary policy with respect to interest rates. Of course, I mentioned that before, financial innovations played certainly an important role, but, and this is my point, we may be now at a situation where we're going to have a bad recession, which is already more than around the corner, which is already there. So, here I come to the last point of my presentation, the subprime crisis. The subprime crisis, which started in 2007, shows that we have, in fact, a comeback of Keynesian ideas, Keynesian analysis. Yesterday, Paul Davidson mentioned the fact that the efficient market hypothesis, based on the rational expectations hypothesis, is completely contradicted by the evolution of the financial sector during this last crisis. And that the Keynesian analysis of finance, with limited rationality, herd effects, and so on, is much more convincing in explaining what happened in the financial sector since last year. But I will use two other interpretations which are complementary to what Paul said yesterday. I would draw again on Minsky, and I would also look at the evolution of the world economic imbalances in the world to show that Keynesian economics is still very, very important to understand. It's still very useful to understand what's going on in the world today. Let's go to Minsky. There is a paper, an article by Minsky, which has been fairly forgotten, I would say, published in 1964, which is called, published in the IR, in the American Economic Review, Longer Waves in Financial Relations, Financial Factors in the More Severe Depressions. What is the idea of Minsky? Minsky explains in this paper that capitalist economies need adjusting periodically. In other words, they need business cycles, and they need downturns in particular to adjust, okay? And when you have a long period of growth without important business cycles, then you have a situation of financial fragility, okay? And as he says, using Minsky's concept, you have a growing proportion of speculative and Ponzi finance. So the idea, drawing on this paper by Minsky, is that today we may be in a kind of crisis following a long-term boom of almost 20 years, okay? In other words, the rate of consumption, rate of growth of consumption in the US was so high and so important that it was a driving factor of growth in the world economy, in particular in export-led growth, developing countries. But at the same time, we had increasing imbalances, okay, in the world. And for instance, you may have this type of diagram. I'm sure you saw that kind of diagram. Maybe you don't see very well. I just comment here. Here you have countries with deficit, current account deficit, and here countries with current account surplus. What do we see? We see that the imbalances were very small in the early 90s, not very far from now, and that it exploded within 15 years. What do we see below here? Two types of countries only. This is a US deficit, okay? And here I think it's Central and Eastern Europe countries here. And here you have all other countries, major regions of the world. In other words, you have oil-producing countries. You have, this is it, this is China, for instance. You have European countries and so on. So you have a huge increase in imbalances in the world. How can we explain them? Well, using some type of Keynesian macroeconomics is very useful. You can see, for instance, that this is the current account deficit balance of the US. So you can see it's going down, okay, as a percentage of GDP since the 90s. And here you see that you have a striking parallelism between this current account evolution of deficit and the balance between personal saving and residential investment of household in the US. In other words, you can see that you explain very well the evolution of the US deficit, okay, by the fact that household sector has been in a very huge deficit, okay, with negative saving at the end of the period. So this is a very, I think this is well known today, but it explains very well the world imbalances, okay. We have to look at household sectors. This is why in our paper we say consumer debt and finance-led capitalism, because we think that consumer debt and consumer behavior is playing a very important role in advanced economy to explain what's going on in the rest of the world. Here you have another diagram for a bunch of developed countries. This is an OECD diagram showing that there is a connection also, a fairly close connection between current deficit, okay, which is here, of developed countries, and the difference between savings and investment in the household sector. If you take a country like the US, it is here. You have countries like New Zealand and Australia. We have very important deficit, at the same time, a negative saving. And on the other side, you have countries like Sweden, Belgium, for instance, Japan, who have. So This may be a very interesting way of interpreting what's going on today. In other words, the crisis here may be interpreted as reflecting the limits of the growth regime we had in the 20 years, past 20 years, based on the US as a consumer debt economy, or if you prefer, as a buyer of the last resort. So now we reach the limits of this growth regime, and this is one way, I would say very Keynesian way, to interpret this in a macroeconomic level, at the world level, to interpret this crisis. Now coming to my conclusion, stemming from all the remarks I just made and the puzzles I just presented, and also to understand finance-led capitalism. In other words, now we are in a world economy with almost 200 countries, which are quite different, with asymmetrical relationships between the countries. And these countries are linked by, of course, the balance of payments, the exchange rates. So we have to improve our analysis, our analytical framework, to understand the relationship between, let's say, emerging countries, peripheral countries, and countries in the center, okay, to understand what is the growth regime, how it is changing, and so on. The other challenge we have is to improve our knowledge, our understanding of finance-led capitalism, in the sense that we see that financialization plays a very important role, but notably by relaxing monetary constraints. And this creates what I call decoupling, or separating of expenditures on one side and revenues on the other side. So to complete my presentation, I just suggest two hints, two ways maybe of going in the direction of a broader analytical framework. In my university, Paris Nord University, and other people also in the other university, in Bordeaux University, in France University, where, I don't know where is Edwin Le Héron, somewhere here, we work very much using stock flow consistent models, but multilateral, in other words, coupling different regions, okay, on building, and we use the work, seminal work by Godelet and Lavoie. We paved the way to this type of approach. So we think this is a way one way among many others, of course, to improve our knowledge. In other words, you introduce multilateral effects, interdependence between different regions of the world, and you introduce stock flow effects, which are the center of finance-led capitalism. Another idea could be to work again using Minsky's intuition in 1964. Why do we have such a phenomena of long booms and then systemic crisis? So is it the new way capitalism is working today? In other words, are financial innovations a way to dampen cyclical evolutions? But once in a while, we have a big crisis. So this is a question, very interesting question today to ask. And I think if there are people looking for doctoral dissertation topics, I think this could be a very good topic for a dissertation. Thank you.
Well, I have a question exactly for Philip, and he asked me to speak in English, so I'll ask the question in English. Yeah. Well, I don't know if I can give this question a short answer, as Ferrari wants, but in positive terms, what do you think is the agenda for Keynesian or post-Keynesian economics? You presented a critique of an important part of mainstream macro, but what do you think can be a set of issues that post-Keynesian or Keynesian economists should focus on, and whether it's possible to build a Keynesian consensus? I don't know if it's a new one or not, but anyway.
I'm very glad you've raised that issue, because I was thinking on the plane coming over here that that's a natural next question. And there are all sorts of ways of responding to that. I think Paul yesterday gave us a kind of clue as to how we might proceed. Go back to Keynes. Read the general theory carefully. Maybe also read some relevant texts like the book that Paul suggested yesterday, and so on and so forth. another way of responding is to say, Fernando and Luis and the rest of them have another conference next year and demand that we come forward with some positive suggestions as to how we might proceed. And my response is that we have to start thinking in terms of lines which the kind of people that we criticize would understand. And I don't mind telling you that I have started already working along those lines, building models which all the Keynesian principles that we've been talking about are there, and the kind of policy implications which would emanate from that attempt. We have a very good supporter, actually, and that is the macroeconometric models of the main central banks. A little bit of work which we have been doing, and it will be published in the Journal of Post-Keynesian Economics next year, says, what do these models tell us about the impact of monetary, fiscal, or other policies that you might think? Are they consistent with the theory that these models are supposed to cover? And you might not be surprised to learn that in terms of monetary policy, the impact on inflation is extremely weak. The impact of there is some impact, significant impact of monetary policy on real variables. There is a significant impact of fiscal policy, as it happens on both inflation and real variables. And all these issues and assumptions and hypotheses which I've talked about today, and this is not me who is saying it, it's the macroeconometric models of these wonderful central banks, which are much, much more Keynesian than what they led us to believe in. Thank you very much.
É claro que a crítica à ideia da função de produção, a função de oferta agregada, é uma crítica muito séria a toda a teoria neoclássica do crescimento, não é? O que é conveniente, porque boa parte da teoria keynesiana se apoia na evolução das condições da demanda agregada. Mas o que a teoria keynesiana, então, pode dizer sobre o papel da oferta, das condições de oferta, no crescimento, sem cair na armadilha das funções agregadas de produção?
A very good question. I'm tempted to give Philip's reply. Can we have another conference next year to answer it? Most of the early Keynesian theories sort of tended to think that supply was in some sense passive. And in a sense, then you don't really need a production function to model it. And I'm thinking of a lot of the early macroeconomic models. It's only with the emergence, I think, as Paul said yesterday, of the neoclassical synthesis that you actually get the supply side coming in. And I think you can get a long way with arguing, even today, with capital accumulation endogenous, with labor supply in many countries endogenous, that you do not need to go down the road of agri-production functions. The difficulty is, it's very easy to criticize, and the sort of questions we get asked is, like, well, what are you going to put in its place? And we haven't got that far yet. I think that is a major research program. But there are a lot of macro. I mean, if we look at Wynn's and Marc Lavoie's model, I don't think there's a production function in that. I mean, there are identities. Identities are not necessarily bad, providing you don't estimate them and think that they are actually telling you something about causation. So I'm afraid at the moment, I think my answer is a little bit vague on that, but it is an area that really needs to be looked at.
I think that everybody is hungry. I think that's time to finish.